The collapse of Silicon Valley Bank is causing shockwaves across the entire...
A rough week for the banking industry.
It is the epicenter of tech startups, venture capital.
As of this morning, Silicon Valley Bank, or SVB, has gone under complete...
...of a collapse of a...
California claims Silvergate is liable for furthering FTX's investment fraud and taking first-hand participation.
The bank stock lost 80% of its value this week, 60% in one day alone, yesterday.
During the first weeks of March 2023, 3 banks in the United States collapsed. It all happened so quickly that hardly anyone had the chance to react. Now the cryptocurrency world and the tech startup world seems to be in big trouble. Here's what happened. On March 8th, after a drop of 94% during the last 6 months, Silvergate Capital Corporation decided to voluntarily liquidate to try and make up for their losses. As a result, their stock price plummeted another 50%. Only 2 days later, March 10th, the FDIC shut down Silicon Valley Bank as their shares plunged first 60% and then another 66% in pre-market trading. Silicon Valley Bank's fall is the biggest bank failure in the United States since the 2008 financial crisis, and the second largest failure ever. And on March 12th, Signature Bank was shut down by New York regulators. This was the third largest bank collapse in American history. Why did this happen? And what consequences will it have? Stay with us till the end of this video while we uncover the scandals and secrets behind the scene. And remember to like and subscribe to become a smart investor so that you are not caught off guard when a disaster strikes. Some people are saying that this is only the beginning of another big financial disaster, but it's still too early to tell. There's a lot of nuance to this situation that needs to be explored. For example, both Silvergate and Signature Bank are traditional banks that help out cryptocurrency companies, while Silicon Valley Bank was a more general bank that served the tech community. But since Silvergate's and Signature's collapses and Silicon Valley Bank's closure are related, it's important to talk about all of them. Cryptocurrency enthusiasts once dominated an exclusive market, but things changed dramatically in the end of 2022. The collapse of FTX, a former cryptocurrency exchange company and crypto hedge fund, and the related fraud involving Sam Bankman-Fried led to a massive withdrawal of funds from Silvergate. In fact, more than half of all cryptocurrency deposits, totaling $8 billion, were pulled out in the last quarter of 2022. To cover these withdrawals, Silvergate had to sell assets worth $5.22 billion, resulting in a staggering loss of $718 million. To understand the magnitude of this loss, consider that the bank's entire profit from 2016 all through the third quarter of 2022 wouldn't be enough to cover this single quarter loss. Banks typically invest a substantial portion of their assets, including customer deposits, in treasury bonds due to their stable value and high liquidity. Although investing in U.S. government bonds won't make you rich, you can be confident that your money is safe and can easily be cashed in if needed. However, many of these bonds were purchased when interest rates were extremely low, almost zero, over the past decade. As interest rates rise, bond prices drop, and the market price of these bonds has fallen significantly. Despite this, bonds are usually safer than stocks because, in theory, you can just wait for them to mature and get your money back. But because of the massive customer withdrawals, Silvergate Bank had to urgently sell these bonds, arguably at the worst possible time. Bonds that were meant to be held to maturity were sold prematurely at a much lower price to meet the cash needs, which increased the bank's losses. As a result, Silvergate issued a statement 2 weeks ago expressing uncertainty about its ability to continue operating. On Wednesday, March 8th, they declared they would willingly close and sell all assets to cover their debts. Yet, the story doesn't end there. Both FTX and Sam Bankman-Fried reportedly deposited nearly $1 billion each into the bank, and now the Justice Department is investigating Silvergate's connections to these two individuals. Interestingly, on the same day the liquidation was announced, issues began to arise at the much larger Silicon Valley Bank. SVB Financial currently controls 4 companies, with Silicon Valley Bank being just one of them. However, SVB represents the largest opportunity for the group, as it contributed over 90% of their gross revenue in 2021. The bank plays a significant role in the IT industry since its primary clients are tech startups. These are companies that are already struggling in the current high interest rate environment and uncertain economic outlook. According to the company's SEC filings, Silicon Valley Bank serves as the main banking partner for nearly half of all U.S. venture-backed technology and life sciences startups. Rising interest rates not only impact bond prices, but also make it difficult for venture capital and new companies to secure funding. This creates challenges for startups trying to establish themselves in the region. The saga continued when Silicon Valley Bank announced a $1.8 billion loss from a fire sale of assets due to the customer withdrawals. The bank is reportedly considering issuing $2.25 billion in new shares and preferred shares to restore its cash reserves. It needs to regain investor confidence, especially in light of a possible rating downgrade from Moody's. While this may have calmed the markets, the venture capital industry reacted with panic, with several firms advising their startup clients to withdraw cash. In just one day, customers withdrew $42 billion, approximately 25% of total client deposits. Because the bank couldn't raise funds or find a buyer within a short time, authorities intervened and shut it down. Now, the world is left wondering what will come next. It's true that banks are generally immune to bankruptcy, but each case is different. Unlike Silicon Valley Bank, Silvergate still has control over its assets and plans to return all deposits and fulfill its obligations through its own liquidation process. Whether they'll have the time and resources to achieve this remains uncertain, but taking proactive steps like liquidation might help. As mentioned, the FDIC has taken over as receiver for Silicon Valley Bank, meaning the bank will now sell off its assets to repay its obligations to shareholders and depositors. The FDIC has promised depositors they can access their funds in only a few days, up to a week at most, which is quite remarkable. However, the reimbursement will be in installments as the funds come in. Even though this seems ideal in theory, a whopping 95.5% of the bank's deposits aren't insured by the FDIC. The FDIC covers business accounts up to $250,000, and some of these deposits are located overseas, making them ineligible for protection. Since most Silicon Valley firms require more than $250,000 to start, the lion's share of their deposits isn't safeguarded by typical protections. To meet demands, the FDIC will need to liquidate as much of the bank's assets as possible. This isn't great for business if clients are hesitant to trust the bank with their money. The more significant concern should be the potential domino effect on the American financial system. During these last few days, trading of shares in smaller banks was stopped, and the stock prices of big financial firms like JP Morgan and Bank of America dropped dramatically. Some of the banks involved were First Republic Bank, Western Alliance Bancorp, PacWest Bancorp, and notably, Signature Bank. On March 12th, a board member of Signature Bank informed the media that the bank had lost over $10 billion. This happened as clients quickly left the bank following Silicon Valley Bank's unexpected failure. The sudden increase in withdrawals caused the third largest bank collapse in American history. To protect bank clients and the U.S. financial system, authorities took control of the signing process a few days later. Signature Bank is located in New York and has strong ties to the real estate and legal industries, and it was one of the major banks dealing with crypto companies. Board member and former U.S. Congressman Barney Frank said the sudden change shocked bank officials. According to a regulatory filing, Signature Bank had 40 branches, $110 billion in assets, and $88 billion in deposits at the end of 2022. Frank mentioned that on the night of March 12th, the bank faced a deposit run directly caused by Silicon Valley Bank's situation. Before this, the bank was unaware of the seriousness of the issue. This event highlights the concerns for U.S. banks exposed to speculative assets during the last health crisis. While Silvergate Bank's collapse was expected, it raised questions about the safety of deposits in banks without federal insurance. To recap, on March 8th, Silvergate experienced a breakdown, and on March 10th, Silicon Valley Bank went down. This unstoppable chain reaction led to the collapse of Silvergate. Things aren't looking good for U.S.-based banks that support cryptocurrencies. Due to the challenge of measuring the risk linked to a financial institution's collapse in the world's biggest economy, there is growing concern about a potential upcoming financial crisis in the United States. So, what lies ahead? It is clearly difficult to assess the risk and implications associated with the collapse of a major institution in the world's largest economy. Many are wondering if this could be the next financial crisis in the United States. However, here are some thoughts, not as a guarantee of a specific outcome, but as a way to frame the situation. While this will negatively impact the cash flows and financial health of venture enterprises, depositors should anticipate getting at least some of their money back. Some are even speculating that they could be fully reimbursed. The same goes for investors, who likely aren't high on the priority list. There is evidence that assets may be available to cover these deposits. Furthermore, unlike recent cryptocurrency disasters, this situation has caught the attention of regulators and major financial institutions. Resolving this dispute favorably benefits everyone involved and helps maintain public trust in the U.S. financial system's stability. Right now, the problem is fairly limited in scope, as it mainly affects smaller, regional commercial banks that serve business clients. There is a chance of bank runs or widespread panic, but it's not very likely at the moment. The major banks, such as Bank of America, JP Morgan, Wells Fargo, and Citibank, are not as susceptible to this issue. They have a broader range of clients and are not as exposed to the particular risks that are impacting Silicon Valley Bank and Silvergate. While the situation at hand is cause for concern, it's not necessarily a sign of an impending financial disaster. By staying informed, maintaining a global perspective, and keeping an eye on the actions of regulators and financial institutions, we can better navigate the complex world of finance. If you found this information helpful, please give it a thumbs up and consider subscribing to stay up to date with the latest financial news and insights.